Hello and welcome back to Bhavani JAIIB. Today we are talking about retail banking, specially made for Indian bank employees aiming to crack JAIIB. In our journey through Paper 4 Module D, we start with the 26th unit, Other Financial Services Provided by Banks. Here we will be learning about the introduction, about mutual funds, insurance, cross-selling, demat account, depository services, and other social security schemes. Banks today offer much more than just deposits and loans. They have moved into para-banking services like mutual funds, insurance, demat and depository services, portfolio management, which we had seen in the previous chapters, cross-selling financial products, credit and debit cards, etc. All these services help customers manage their wealth better while also increasing the bank's revenue. Next, we will be looking at the mutual fund business. So, what is a mutual fund? A mutual fund is a pool of money collected from investors to invest in shares, bonds, etc. In other words, we can say that it is when many investors put their money together and professionals invest that in shares, bonds, and other assets. For example, you and 100 others invest 5,000 each, rupees 5,000 each. The fund manager uses this 5 lakh rupees, that is 100 into 5,000 will be 5 lakh. So the manager uses this 5 lakh rupees to invest in the stock market. Your return depends on how the investments perform. So here we will be looking at the features of mutual funds. The first feature is the professional management. Next is the diversification, that is, you are going for less risky funds. And next is the lower transaction cost. And then it is the liquidity, that is, it is easy to sell or easy to exit. And next is simple to invest. Okay, and also it is transparent and regulated by SEBI. So these are the features of a mutual fund. It's a great option for small investors looking for exposure to the market without deep expertise. So someone who doesn't have much knowledge into share market or market can invest in mutual funds. So what are the different types of mutual funds? We have the equity funds, we have the debt funds or the income funds, and the balance funds, index and money market funds. There are many more, but we are just looking at some of the main types of mutual fund. Equity funds refers to the investment in shares. Okay, so this is mostly what people actually invest in. Debt funds are the bonds and fixed income securities. These are some of the bonds that people invest in. Hybrid funds is one more type of fund where you are mixing equity and debt. So a mixture of these two will be called as the hybrid fund. Next is a money market fund. The money market fund is a short-term investment. Okay. Next is the solution-oriented. That is, there are some people who want to invest in mutual funds for the sake of retirement or child savings. That is, when the child attains certain age for graduation, they want to invest some money. So this is called solution-oriented. There are other types of funds. Okay, and that is called the ETFs or the index funds and all those things. We don't have to go very in depth about these things, but we have to just know the different types of funds, of the mutual funds. So SEBI has categorized these to help investors make informed choices. So next we will move to the insurance business. So insurance business, as we all know, we have different types of insurance. Right? Banks also distribute insurance policies, like they cover the term insurance policy, which covers for a fixed time, the whole life insurance policy, which covers for life. Endowment plans includes insurance plus savings. Like this plan, I think, is very common that we are investing both in insurance and also as a part of savings schemes. Next is the ULIPs, the unit linked insurance plans. That is, this is a form of insurance plus investment. That is, you are taking an insurance and also the part of the money is being invested in the market. So this is about ULIP. Next is the money back plan. So this is also very common. Regular payouts plus insurances. So where people try to invest in some plan which will give them some money payouts maybe regularly every month or every quarter, or it depends, right? So this is about the money back plans. Next we have the health insurance, which is most commonly we all know about this. It helps to cover the hospitalization charges, surgeries, etc. Here, we will just take an example. See, for a small annual premium, you get coverage for a large medical expense. It reduces the financial burden during emergency. So that's the reason people actually go for health insurance. So here it protects against death, medical costs, property loss, accidents. So all these things are what the insurance business is trying to cover. Next, we will look at cross-selling. So what is cross-selling? It is to sell related or complementary products to a customer. It is selling related products to existing customers. For example, a person who takes a home loan is also offered a home insurance plan. So this is like you go for a home loan, we are also giving a home insurance plan. So that becomes cross-selling. Banks use data and relationship banking to cross-sell efficiently. So here, what are the effective strategies to use cross-selling? So nowadays, banks actually want us to do this, right? So there is more focus on cross-selling rather than just giving your products out. They also want you to cross-sell. So here we are looking at the strategies. That is, you need to have a very strong customer database. You have to understand what customer needs. You have to train the staff to offer right products at the right time. So you need to know the products for you to offer it to the customers at the right time. Use of technology to map profiles and to make it part of the branch culture. So this is about the effective strategies of cross-selling. Next, we move to the Demat account. Demat account holds shares and securities in electronic form instead of physical certificates. So here we have, see, it is dematerialized. Share ownership certificate converted from physical paper to digital. So they're converting this physical certificates into digital certificates. So used for trading shares online, essential for stock market investment. So earlier times, what used to happen was before we had this demat accounts, these stock market investments used to happen manually or in the form of physical paper. So now that demat accounts have been introduced, these physical format have been changed digitally. What are the benefits? So what are the benefits? There is no risk of fake or lost shares. So easy transfer of shares. Okay. There is quick settlement also. You know, if you have a physical paper, you have to go about and do all the paperwork. So as I just said, there is low paperwork. So that is the benefit of having a demat account. Next, we move to depository services. So what are depository services? Depositories are financial entities that hold your securities in an electronic or demat format. So depository is like a bank, but for securities like shares, bonds, etc. So the services offered usually will be open and manage demat accounts, dematerialization and rematerialization. Dematerialization is where I just spoke about, is where you are turning the physical papers or the certificates into digital securities. But rematerialization means it is a process of converting the electronic shares back into physical share certificates. So D and re. So you in rematerialization, you're going back from digital to paper, physical paper, to pledge the securities, to receive bonus or rights or shares electronically, and also to transfer securities, to settle stock exchange trades. So these are all the services offered by the depository services. For example, instead of receiving paper share certificates, you get digital entries in your demat account, which are safe and hassle-free. So this is about depository services, right? So you need to understand the depository services. Depository is like a bank, but it is for securities like shares and bonds only. Okay. Next, we move to the social security insurance schemes. This we are very commonly listening in the banks, especially in the public sector banks, because there is more focus on these schemes given out by the government. These are affordable schemes aimed at the poor and informal workers. So this main focus is on this group of people. The first one is the Pradhana Mantri Jeevan Jyoti Bhima Yojana. Jeevan Jyoti Bhima Yojana, right? It is PMJJBY, it is called in short. So this is a life insurance worth of 2 lakhs on death. And the age is between 80 and 50 years. And the person needs to have a bank account. The premium is 436 rupees per year, auto debited, and it gets renewed every year. It is administered by LIC or other life insurers in tie-up with banks. So this is about PMJJBY. The next one is the PMSBY, that is Pradhan Mantri Suraksha Bima Yojana, which is an accidental insurance. This is a life insurance, this is an accidental insurance. The age is between 18 and 17, and the coverage is for 2 lakhs for accidental death or full disability. Okay, this also you need to keep in your mind. Even for full disability, you will be getting the amount. 1 lakh for partial disability. But the premium will be 20 per annum. It is managed by the public and private insurers available to all bank account holders. So now we have the targets to reach PMJJBY and PMSBY. So we also have one more scheme here, that is the Atal Pension Yojana, which is called as APY. This is a pension scheme, and the eligibility is for people between 18 and 40 years, and the KYC is required. The pension amounts from rupees 1000 to 5000 per month after age 60. So you'll be getting money from 1000 to 5000 as per your contribution after the age of 60. Contribution is based on the entry age and desired pension. So you have a chart actually which tells you that what would be the amount you need to pay as premium, whether you want to pay it monthly, half yearly. So it is your wish. And this amount will be calculated and it will be given to you as pension based on your contribution. It is based on the entry age and desired pension. So Government of India core contribution will be 50% of the contribution, or rupees 1000 for 5 years for non-taxpayers. So upon the death in this scheme, pension goes to the spouse or corpus or to the nominee. So this is about the social security insurance schemes. So far we have learned about the introduction of other services provided by banks, mutual funds, insurance, cross-selling, demat account, depository services, and the social security insurance schemes. Don't forget to subscribe for more insights into the world of banking. Stay tuned, stay informed, and keep banking the Bhavani JAIIB way. Thank you and happy banking.